Welcome to The Explainer. Today, we're unpacking a massive tension that pretty much every single person in the markets deals with. The tug of war between long-term strategy and, well, short-term market euphoria. I mean, the sheer volume of info and the lightning speed of modern trading, it's intense. But beneath all those complex algorithms and the endless 24/7 financial news cycle, there's a huge psychological pitfall just waiting to drain your capital if you don't have a strict analytical framework in place.
Okay, let's dive into this. Every single investor, whether you're just starting out or managing a sizable portfolio, faces a harsh statistical reality. Retail trading booms historically wipe out billions of dollars in wealth. Yeah, billions. So the real question of avoiding the biggest beginner investing mistake isn't just about protecting your initial cash, it's about surviving that critical first market cycle. Institutional data consistently shows us that the single biggest error newcomers make is entirely behavioral. It's driven by psychological biases, not a lack of smarts. The good news? By understanding exactly how this error works, we can proactively build systems to protect our portfolios from those massive, totally avoidable drawdowns.
Section 1. The biggest investing mistake.
Let's pull back the curtain and reveal exactly what this massive pitfall is. The mistake? Chasing hype. Basically, it's throwing capital into an asset simply because it's the popular thing to do right now. It's driven purely by raw emotion and momentum instead of actual, careful analysis. I mean, we've seen this movie before, right? From the dot-com bubble to the more recent meme stock manias and crypto frenzies. It fundamentally boils down to FOMO, the fear of missing out. Our brains are literally wired to seek safety in the herd. So when an asset's price rockets to the moon, it triggers this crazy dopamine loop. Panic sets in that you're being left behind. And before you know it, all analytical rigor goes right out the window. People deploy capital into complex, volatile instruments without having a clue about the underlying valuation, just hoping they catch a ride to the top before the music stops.
Section 2. The social media illusion.
Let's see how this builds, because, this emotion-based mistake doesn't just happen in a vacuum. It gets aggressively weaponized by our digital environment. Think about it. Your friends are posting overnight wins. Influencers are flashing these massive, unbelievable returns. The charts are green. They're pointing straight up. Your heart starts racing. The anxiety builds. You feel paralyzed by the thought of being left behind. And here's the thing. Social media algorithms are literally designed to create this intense echo chamber. They hyper-target us with a constant barrage of selective success stories. It manufactures this bizarre reality where risk is invisible, losses are totally hidden, and outsized gains seem, well, normal, effortless, guaranteed even.
But let's take a deep breath here. And this brilliantly illustrates the stark reality dividing two incredibly different mindsets. What gets heavily promoted online? That's rarely investing. Actually, it's speculating. Speculation relies almost entirely on the greater fool theory. Buying an overvalued asset just hoping someone else, the greater fool, will buy it from you at an even higher price later. True investing, on the other hand, demands an entirely different set of mechanics. It requires a rigorous evaluation of intrinsic value. We're talking about analyzing free cash flow, understanding competitive moats, and making strategic decisions based strictly on deeply researched fundamentals and your own personal long-term asset allocation targets.
Section 3. Severe financial consequences.
We need to slow our pace down here for a second, because we really have to talk about the hard truth of what actually happens when capital is deployed based on pure speculation. The domino effect of hype is a devastating and frankly completely predictable chain reaction. It usually starts quietly, just one single emotionally charged, impulsive decision to buy in at the absolute peak of a mania. But because the herd has driven the price so far beyond its actual intrinsic value, a harsh fundamental correction isn't just possible, it's mathematically inevitable. When that bubble bursts, the crash is violent. Stop losses get triggered, margin calls wipe out over-leveraged accounts, and massive amounts of capital just evaporate. But honestly, the ultimate tragedy isn't even the immediate financial hit. It's the severe psychological trauma that follows. That total loss of confidence often drives retail investors out of the market entirely, which causes them to miss out on literally the most powerful wealth-building tool in existence: decades of compound interest.
Section 4. The disciplined approach.
Fortunately, there is a highly methodical, concrete solution to insulate your portfolio from the hype machine. Avoiding this trap requires internalizing 3 really rigorous steps. First up, doing your own independent research. This means going straight to the primary sources. We're talking reading 10Ks, scrutinizing earnings transcripts, calculating PE ratios, running discounted cash flow models. Basically, not just taking someone else's word for it. Second, setting crystal clear parameters. You absolutely must define your specific time horizons and gauge your true personal risk tolerance before a single dollar is deployed. And third, relentlessly sticking to your strategy. Building a solid foundation demands ironclad personal accountability. You have to refuse to deviate from your analytical framework even when the market's momentum is just screaming at you to pivot.
The difference between catching a lucky, fleeting gain and creating actual generational wealth, it comes down to execution over decades. Short-term hype treats the stock market like a casino. It's driven by raw emotion and the desperate search for an overnight anomaly. But a long-term perspective, that treats the market as an engine for compounding value. It requires immense patience to let the fundamentals actually play out. It means utilizing proven strategies, like dollar-cost averaging, to navigate your way through brutal bear markets without panicking. True investing is a quiet, continuous dedication to reading, learning, and steady execution over the long haul, while entirely tuning out the noise of the daily news cycle.
So the crucial point is captured perfectly in the mandate to focus entirely on the process rather than the outcome. Adopting this mindset fundamentally shifts how you interact with risk. Think about it. The daily outcome of the market, which is driven by macroeconomic shifts, unexpected geopolitical events, shifting interest rates, is completely outside of your control. Obsessing over those daily fluctuations, that just turns you into a reactionary victim of the hype. But your process, your asset allocation, your risk management rules, your diversification, your analytical rigor, that is 100% within your control. By pouring all your energy into executing a flawless process, the long-term positive outcomes naturally take care of themselves.
Bringing it all together, the source material ultimately proves that market success is less about outsmarting the crowd and almost entirely about out-disciplining them. Which brings us to a question for all of you joining me today. Have you ever fallen for the hype? Be honest. Almost every great investor has an early story of miscalculating risk. More importantly, what did that specific experience teach you about your own behavioral blind spots? I would absolutely love to hear your analytical takeaways in the comments below. Take a moment today to really audit your own financial processes. And remember, if you want to keep building that long-term analytical edge, don't forget to subscribe for more deep dives. Thanks for watching this explainer, stay disciplined, and I will see you next time.